My name is Robert Ansari. I head MSCI for the Middle East, based here in Dubai. And I'm here with William Davies from Threadneedle. We're at the Global Asset Allocation Summit, courtesy of FundForum, and we're going to ask William a few questions about the panel we just sat on. So William, one of the first things we spoke about at the beginning was globalization of markets and whether or not now we feel that investors view the emerging markets as one homogenous lump, or if they view them as segregated markets. What are your thoughts on that?
In terms of markets around the world, people still like to look at them as blocks. People still like to look at emerging markets as one block, as developed markets as one block. And quite frankly, that can lead to real problems, because if we look at emerging markets, there are those emerging markets which may be commodity exporters, those which will be commodity consumers, and they're going to react in completely different ways if we see commodity prices move one way or another. Similarly, with current account deficits, we have problems like that within emerging markets economies. And if you go to developed markets as well, again, people look at that as one block, but obviously they dance to different tunes at different stages of the cycle.
Sure. So we obviously one of the biggest events that will happen in the coming months will be the cessation of the quantitative easing in the US. How do you think that will play out in terms of rate rises and impacts on certain investment strategies like, say, high dividend yield?
In terms of its impact on investment strategies, I'm not as concerned as many other investors, because I think the tightening cycle has already started. The tightening cycle started really when President Bernanke, talked about the introduction of tapering last May. Long bond yields went from 1.5% to 3% in the US in no short time. And this year we've seen the tapering occur, and next year we'll see interest rates start to rise. But we're looking at interest rates rising gradually, not dramatically. We still believe we'll be in a pretty low growth environment. And so if we look at high yielding stocks which can continue to grow their dividends, I think will continue to offer an attractive investment opportunity.
Well, we saw the impacts of the Fed tapering announcements last year on the emerging markets. Do you think the emerging markets are set for a double whammy, especially with the number of geopolitical risks that we're seeing in those markets, Russia, Ukraine, for example, the impact on the Eurozone?
I think the increase in interest rates won't be the double whammy, because I think the biggest impact was from last year when we saw long bond yields rise surprisingly quickly from 1.5% to 3%. This time it's much more tailored. Investors are ready for it, and increases in those yields, I believe, will be more gradual as we move forward. So for emerging markets as a whole, I don't think it's going to have a similar impact. What I would say though is, you mentioned some of the geopolitical risks, and in terms of geopolitical risks, then those certainly can affect certain economies and certain markets. And within emerging markets, you'd have to say that with sanctions increasing between Russia and the rest of the world, most particularly Europe, we'd expect Eastern Europe to come under some pressure there, and obviously the Russian economy as a whole. So we'd be a bit more nervous about the outlook for emerging markets within that particular region for those reasons.
Sure. Now, Japan has been mentioned a few times today as a fairly hot market, and you're pro-Japan currently at the moment, at least. In a nutshell, what's your reason for backing the Japanese market at the minute?
We're seeing a revolution in Japan, Robert. I mean, that revolution, it started off being monetary with the printing of money, but with Abenomics, we've seen fiscal stimulus. Not this year, though, as we've seen the increase in consumption tax. But what we're seeing is at the corporate level, at the company level, we're starting to see reform taking place. We're starting to see profits coming through, return on equity potentially doubling over a period of 3, maybe 4 years. That to us, that increase in returns is going to be reflected in further share price increases within Japan. It's the area we're probably most positive about around the world over the next couple of years.
Okay, well, thank you for your time.
Thank you, Robert.